Hello again. A fairly quiet summer, hope you all had fun, has given way to anything but a garden variety fall. COVID-19 concerns linger, but the economic resurgence begun last summer continues. The beginning of the fourth quarter of 21 sees equity indexes uniformly positive to date, but a closer look reveals a stock market that has largely stalled since midsummer. The 10-year U.S. Treasury yield has climbed back to its diminutive heights of earlier this year, while the bond markets grind to consensus on the proper level of interest rates. Volatility, while not approaching what we saw a year and a half ago, has picked up. Why? We believe the uncertainty about three fears above all are driving market churn. First, inflation fears. Prices have noticeably risen while supply issues continue. A trip to the supermarket is likely more costly, and you are bound to see some empty shelves. Like COVID, these supply issues have moderated yet persist. Inflation, if it continues, will require a restrictive monetary policy response, such as repeated interest rate hikes. Secondly, China debt fears. Chinese real estate financiers Evergrande Group and Fantasia Holdings have defaulted on payments to bondholders, and if they fail entirely, it could hamstring the near-term growth of the Chinese economy. This alone would be a relatively minor concern, but for the potential for global contagion. There are likely more companies with financial troubles than we know of today. The effects of a significant liquidity crisis in China could also echo around the globe. The third concern is Fed tapering. The emergency actions put in place last spring appear no longer necessary, so the $120 billion of bonds bought every month will stop as soon as November. Removing this emergency measure is not meant to be restrictive, but will a market and economy that has taken hyperliquidity for granted manage this transition to normality without a hitch? We account for these risks to varying degrees within our portfolios, but on balance, we believe U.S. growth prospects can survive China's partial deleveraging, and that tapering has been extremely well telegraphed by the Federal Reserve. Shorter-term inflation risk, however, could be greater than the average market participant expects. To that extent, we have increased our portfolio weighting to inflation hedges and may continue to add more before the end of the year. The best inflation hedges in the past have been things like gold and real estate and blue chip stocks whose businesses are healthy and their products are in demand. This is also the season for those 72 and older to make sure you've taken your required minimum distributions for 2021. If you have any questions about your portfolio or know someone who may benefit from our advice, please reach out to your advisor directly. Thanks and enjoy autumn.